left, again, need no introduction. I think we all know who they are and have a number of successes under their belt. So, I thought what we could do tonight is cover a number of different topics: macroeconomic, microeconomic, what you like out there, what you don't like out there. And again, the format tonight will be very similar to what it was last night, Rick, which you also joined us, which is we'll start off with you and anybody else on the panel that would like to, answer or add to the question, please feel free. So, one of the topics that's sort of come up throughout the course of this show, and I think generally speaking, is the state of the global economy, specifically what the predominant economic force is. Is it inflation, deflation, disinflation, stagflation, whateverflation? Where are we? What do you see out there, Rick?
With the caveat that I'm a credit analyst, or really a loan shark, and not an economist, I guess my outlook on the economy is mixed. I'm certainly of the opinion, like Doug Casey, that the ascent of man is the longest unbroken bull market in history. I do have a problem with the political management of the economy, and in particular, the suggestion that seems to have found favor among voters and people in the market that liquidity is a substitute for solvency. The idea that short-term capital markets are flush with counterfeited money, quantitative easing, and that somehow absolves us from living within our means is something that's problematic for me. So I look at the success of private markets, and I look at the interference of governments, and I see two sort of forces that would like to collide, and I kind of hope that I'm not around when they do.
Sure. Any other comments from the panel?
Well, it's really hard to tell where we're at, but the way I read it is that the world is in a state of contained depression. But I think the result of this, because of how this has been addressed, is going to be eventual very high inflation. And it's only a question of time, but the way that the world central banks are behaving to manage what is in reality just a lack of aggregate demand will create the basis for future inflation. And I think that the only thing missing in the equation, which will eventually come, is the velocity of money. That has to pick up. And once the velocity of money picks up, then I think you're going to see much higher inflation. And that's how I see the world.
Sure. Murray, any comments?
So we've, what did you call yourself, Rick? Moved from the credit analyst to the mining engineer, so I'm even less qualified to comment on the economy in any particularly informed manner. However, I would, on the inflation versus deflation exercise, I guess most of us as we live life don't see much deflation in our pocketbooks. And the general comment that inflation is controlled, if you were to say running a mining company was a measure of real consumption and real prices, then everybody can see the effect on the operating costs of gold companies of what's really going on from an inflation perspective. So whilst we see the threat of deflation as measured by economists present, we see no evidence of it in the real market. And then if you turn to where stock market levels are currently, and you turn to, I'm sure you've heard 3 days of money's being printed. We can't help but see an acceleration of inflation at some point, and to be honest, we would worry in the longer term more about hyperinflation and its consequences on the resource market than we would about deflation at this point.
Sure. Okay. And Frank Giustra, we'll start with you on this one. One of the comments, I think, coming out of 2013 was the disconnect between the equity markets, with the S&P up, say, 30% or whatever it was, the Nikkei up 57%, and the performance of the actual economy. So that disconnect, and that's led to all sorts of bubble talk, bubble in the stock market. Where do you see bubbles out there? Do you see bubbles in the market? Do you see it in the art market, for example, in housing? What do you see as key places primed for a downturn?
There are many bubbles everywhere, and everywhere you look. But I think if you want to really think about where the current bubble is, I think is in the S&P 500. The reason I say that is because there hasn't been any real growth in aggregate demand. Earnings have been driven mostly by cost cutting and lower financing costs. And when you think about what's really happened is with all of this free money that the Fed is creating, you've seen that in the past since 2009 when this bull market started, about $1,600,000,000,000 worth of share buybacks and $1.2 trillion worth of dividends paid out for a total of $2.8 trillion, and that is what's driving this market. You only have to look at the record cash flows that are being created, $2.3 trillion in cash flows, and still you've got all of these companies, the non-financial corporations, that are out there issuing about $660 billion worth of refinancing, new bonds, and what that tells me is that with access to all of this cheap money, these corporations are using it to buy back their shares and pay dividends as opposed to investing in CapEx or hiring, and that's what's driving the market higher. It's nothing else than that at this stage, and what everybody's hoping for is that actual growth is going to pick up in the economy, which will drive demand and drive revenue growth.
Sure.
But the other the bubble that you have to really worry about, and the one that's coming down the road, are bonds. I think bonds are a holocaust in the waiting, and the art market's too small. It's a very selective part of the art market that's performing really well, and that's a very small population that plays that, invests in that, and housing's very localized in the high-end markets. So you have many bubbles there, but that's not going to affect people in general. What's going to affect people in general are the bond market and the stock market.
Sure. Any other comments from the panel on bubbles out there?
In history, there's quite a bit of compelling research that goes back 400 years on bubbles, and bubbles are usually caused by excessive debt leverages. So the crash of '87 was the advent of innovation for the futures market of hedging S&P, and everything was excessively leveraged. This last stock market bubble we had was where real estate was able to be leveraged 99 to 1. I would meet people that were secretaries that owned 3 condos in Vegas because all they had to basically put down was $2,000 and they could leverage everything else. So the art of looking at this is A, there's usually financial engineering, 2, government policies allow excessive leveraging, and the third part is usually covenants. Covenants for collateral start to deteriorate. So you don't see that, as I agree with Frank, in the art world. It's a very small world, and it's not leveraged. It's not excessively leveraged. When gold hit $850 in 1980, it was, and silver $50, it was predominantly futures market that drove that spike, and that was once again this huge leverage. So I don't really see that in the capital markets right now, but every talking head on CNBC, et cetera, has a PhD in bubbleology. And they're all trying to call bubbles.
Sure. Well, one of the things that you touched on, and I think many people believe is the cause of the bubble, and Murray, we'll start with you on this one, but a lot of people are looking at central banks as the cause of some of these bubbles, in particular the Federal Reserve. Now, we've just seen a leadership change in the Federal Reserve, so Bernanke is on his way out, Chairwoman Yellen is in, Stanley Fischer is the vice chair. What are your thoughts on that? Is Janet Yellen and other Bernanke, what are the implications of this new Federal Reserve regime, for lack of a better phrase?
This is probably one of the subjects I'm not very well qualified to comment on. I was supposed to be here yesterday afternoon to speak at 5 o'clock on behalf of my boss, Ned Goodman. And the analogy that he used was that what was going on with the Fed was a crowning and a coronation rather than a change of the old guard. The other thing that seems to be going on with the Fed is that each time we have a correction, we were talking about, the other thing that my boss would say is that he has extreme concerns about what's going on in the currency market and what will happen with the U.S. dollar and what the consequences of its loss it's losing its position as a reserve currency. So I guess we watch the coronation of Ms. Yellen with interest.
Sure. Any other comments?
You need somebody better qualified on that one.
Any other comments?
I'm an American taxpayer, so I'll take a run at her. I think relative to the club that they suggested for the job or looked at for the job, she's probably, one who would do less harm than most. left to my own devices as a taxpayer, I'd rather have Frank Holmes or Frank Giustra as head of the Fed. I mean, they've actually had jobs. You know, they met payrolls. They had to create a product. They had to either make other people money or go out of business. The problem I have with the whole sort of Fed club is that they're disconnected from the organizations or the system that's created the wealth that is America. You know, the discussions they have. I read this piece in Foreign Affairs the other day by Greenspan, and he used to be a right guy, 30 years ago. And he said he missed the housing collapse in 2008 because it didn't conform to his model. And he's supposed to be watching markets, not models. And the difficulty I have with these schmucks is that they all sort of talk in bank speak, and they all watch these models. And I say, none of them. I think Ms. Yellen is probably a very smart and a very honest and a very sincere woman. I just think that she lives in a different world than the world that she's trying to run. As I say, I wish once in her life she had to make a payroll.
I'm going to be less kind than you. I think Yellen is just another in a series of academics and well-trained circus dogs. And I think that she will do whatever the government pressures her to do, and to some extent Wall Street. The relationship between the Fed and government and the Fed and the markets was once defined and very separate, and that's gone out the window since Greenspan came in, and I think it's just an absolute joke.
Sure. Any other comments? No? All right, Frank, we'll start with you on this one. You've written a lot about China over the years and your bullish stance going forward. So given China's recent announcements of structural reforms coming out of the third plenum, can China change its growth model from investment-led to consumer-led demand fast enough to continue to lead world growth?
Well, I just think you've seen two big policies take place. One is they can have two children.
Sure.
And two is this, in a lot of the communist countries, they've existed with two social security cards. One if you lived in the rural areas, and the other one if you lived in the city center. So most of those workers, those migrant workers, have been up to 50 million workers that would go in and build infrastructure in the cities. They could never move their families to the cities because they could never get health care. They could never enter the school system. This is called a HOCO, and this HOCO is being removed as to one. It'll be one social security, and you'll see anytime you hear of an empty apartment in a third-tier city, it'll be absorbed quickly. So I think that you're going to see this consumption pattern change, and you're now witnessing, it still isn't through the halfway mark, the construction of 25,000 miles of light-speed rail that goes 300 kilometers an hour. Now, I've taken this from Shanghai to Beijing, and it's quite remarkable, and it's almost like Eisenhower did in the 50s for interstate highway system. When that's built, you will see the movement of people and consumption of products and services that is mind-boggling in numbers. So I think that China will go through its process of evolving, and they'll make their mistakes like everyone else. But I think that they're hooked up, and what the average person doesn't realize is that they have been sending for 30 years to Canada and the US their smartest people. And many have gone back. I know we have gone through US Global, a dozen Chinese people that have gone back to mainland China, and they want that American dream, and they now can see it. So I would say I'm very bullish from that stance and that position.
Any other comments on China and its growth sort of shift? Anything? Okay. Rick, this next one is for you. You talked earlier how you're a U.S. taxpayer, and I want to kind of stick with that theme with respect to taxes, specifically looking at France. France has instituted a millionaire's tax now to the tune of about 75%. What sort of reassurance or what guarantee do you think we have here in the West that something like that can happen?
The guarantee is the new simplified tax form. What did you make? Send it in. I'm reminded that Ambrose Bierce, who's my favorite political philosopher, described elections as advanced auctions of stolen property. And my suspicion is that with 25% of the population in the United States or Canada being earners and 75% being spenders, That type of democracy is a democracy where three coyotes and a lamb argue over what's for lunch. In the audience, look in the mirror, you're the lamb. I think tax rates are probably inexorably higher. If tax rates aren't inexorably higher, what they do is they tax the unborn generation by spending against 30-year bonds. I guess, France has always been ahead of the United States in terms of the race to the bottom. But we Americans are extremely competitive, and we tend to win every contest that we set out to. And I suspect that we'll pass the French eventually because that's our want.
I think being a Texan, you all come back living in America for over 20 years, it gives you a different perspective. And I have to completely agree with Rick. It is so competitive. America is competitive, and like I spoke yesterday, the political regime that's taking place on Democrats or Republicans, it is a hockey game. It's like the Canucks the other night. In the first few seconds, everyone's a brawl. Right? It is a sporting event. And once you can sit back and look at that as being a sporting event, you understand the dynamics. And there is the movement of the Tea Party, and it gets affected with the religious right that's basically trying to infiltrate it. But if you really look through it, it's conservative Democrats and they call liberal Republicans that are really behind it. And the mayor of Miami was thrown out of power with a recall by the largest car dealer because he tried to hike $185 million tax base on real estate for the unionized government workers. And so he wrote his own check and had him thrown out and had that tax increase stopped. He is not a member of the Tea Party. So I think that the idea of going to a 70% or the tax like you talked, the original question on France, I don't see that happening in America because you'll just have this competitive arena takes place.
I think you're overly confident. Listen, yes, can it happen in America? Absolutely. Will it work? No, because throughout history, every time you've raised taxes on income and capital, the world is awash with tax lawyers and accountants that are millionaires can easily afford to move their capital and income elsewhere. So I don't think that that's ever going to work. It may happen. I don't think it's going to work. What you should be worried about is being caught off guard, such as happened in Cyprus, with basic confiscation of savings to pay government's bills. And even the IMF recently floated an interesting idea, a one-off capital levy, as a way to take the wealth of those that have it to pay the debts of government. Those things can happen, and that's sort of financial repression that has been used time and time again, even in our lifetimes throughout the world, whereby you basically start to inflate the debt away and then impose capital restrictions so that the markets can't take evasive action and get the money out of the country. And that's a form of theft, and it's happened many, many times, and there's no reason why it won't happen here or in Europe.
Okay.
Just to complement that thought, I agree with Frank, is the G20 meetings has nothing to do with trade. Just understand that. It has nothing to do with trade. It's tax collection. It's unilateral agreements between all these finance ministers to turn around and try to prevent you from moving from one jurisdiction to another. And it's just, and you see these protests taking place, but really it's tax collection.
Sure. Frank, let's start with you on this one. Murray, you talked briefly about reserve currencies and reserve currency statuses. Obviously, the U.S. dollar is the current reserve currency, but you're starting to see, again, countries like China start to move away from that, whether or not it's hoarding gold or swap agreements. What are your thoughts on the future of the U.S. dollar as the reserve currency? Can it ever sort of potentially be dethroned or delegitimized by the renminbi?
Perhaps eventually. I don't think it's going to happen anytime soon. I think the U.S. dollar has far too much depth and widespread use as the reserve currency. There's going to be a while before it's replaced. I think there's more danger of it being destroyed through inflation than being immediately replaced by any other one currency or a basket of currencies and commodities. But I think that China because you mentioned China. I mean, China sees the writing on the wall. I mean, think about it this way. China is the world's largest gold producer. They export zero of their gold. And in fact, they import a ton of it. Most of what was sold through the ETFs last year ended up going through Swiss refineries and ended up in bars in China. And they encourage their citizens to do the same. So you have to ask yourself, what is it that 1.3 billion hardworking, industrious Chinese know that we don't?
Sure. Any other comments on the USD?
I think I totally agree with Frank just regarding the gold consumption. It's amazing during the bear cycle that they are consuming so much gold. They took all the world's mine supply last year, all the supply, and imported it. So I think it's a thought process that's important because they are now doing trade outside of the US dollar. 60% of all commodities that they purchase from Africa and other countries, they're not denominated in US dollars. So that therefore it doesn't go through New York City, and it's direct with those countries. So that is a movement that I think is important. But to dethrone it, I think you have to take a look at the military power. And it's really hard to compete with American military power. Not only the sheer size of it, but the technology. I live in San Antonio. We have 3 military bases. It shocked me as a Canadian moving down to understand the highway system is to connect actually all the military bases, hospitals, intensive cares, all the new technology that comes out, amount of money being spent by the military locally with independent entrepreneurs. When you look at that and that they have 125 bases around the world, I think that that's an important factor for the currency to remain so significant.
Murray, we'll start with you on this one. Frank, you mentioned precious metals demand in Asia and China in particular. And so if these reports of strong precious metals demand in Asia are true, why the disconnect in the gold price? Wouldn't you expect to see a much higher gold price at this point?
If you'd seen us speaking here last year, well, not here, but talking to clients last year, we certainly have expected to see a much higher gold price. Rick's partner, Eric Sprott's done some very interesting work in the area of physical demand, which points you to the fact that something else must be going on in the market. That the apparent amount of gold to have traded and to have gone into China that went in last year. So we're not traditionally not a conspiracy theorist, but we do really start to question where the bullion's coming from that is going into China. And particularly against an environment where somebody has moved in India to restrict imports into a country that's usually the second largest consumer in the world over the last quarter. So again, it all points to a system that seeks to portray a situation where everything is normal and rosy against this background that we've talked about of record bank debts. So to my mind, we probably have worked with us a gentleman called Martin Murnbeld, who's one of the more informed people on an annual basis about the accuracy of the gold price. And it's interesting this year to look at Martin's 2 scenarios. He has, which he always has in any gold price forecast, he has the one that he thinks is most likely, which is a sort of average price this year of, I think it's a little over 1,200 and an exit price of 1,300. But equally, and for the first time in a number of years, he has a forecast that sees the gold price exit this year, average $1,000 this year, and exit something like 1,100. And that's really driven by what went on in last year's gold market and a short-term effect. But everything that we see, to us anyway, tends to suggest that we must see much higher gold prices in a situation where one country consumes, from an investment perspective, seemingly an entire year of mine production. Something very, very different happened in last year's gold market.
Sure. Comments?
My favorite subject. Yeah, the disconnect that you're referring to was caused, in my mind, by 2 dynamics at play at the same time. You had the liquidation of 800 tons of gold through the sale of ETFs. And you had the equivalent of about 600 tons decline in net long positions from the futures traders on the COMEX. All of that was converted to physical bullion. So you had, and it was shipped through the London bullion markets and through the Swiss refineries to India and China and other Asian countries. So you had the two dynamics at play where paper to physical and west to east. And so that's the reason why it came down, and you still had all of this physical demand coming out of China. You know, just talking about what John was talking about, you know, how the system, you're not quite sure, and I've never believed in conspiracy theories, I hate them, but you have to wonder, when you talk about India as an example, India's gone out of its way to try and prevent its citizens from buying gold, and they've tried everything, including begging, you know, taxing, restrictions, you know, just confiscation, all sorts of things to try and prevent and protect their currency to prevent the import of gold. It's worked somewhat, but it still doesn't prevent the Indians from buying gold. They still find a way, legal or illegal, to buy that gold. And so I think that what's happening in America is that if you believe in conspiracy theories and that a rising gold price at a time of crisis is not good for governments, you know, it just sends the wrong signal to the marketplace and the loss of confidence, that if you can't prevent your citizens from buying gold, make them think it's useless. And so you've got a couple of dynamics at play. You've got Bernanke out there. He probably said about 4 things last year to talk down gold. He basically said that he doesn't understand it. He never understood gold, which is actually not true. He understands it quite well. That central bankers only own it as a matter of tradition, and that it's an asset, not a currency. And that the need for insurance that gold provided is no longer needed because people are at ease now and that the crisis is over. So that all of those statements, if you take them and group them, and they all came out in the latter part of last year, tells me that they don't want you to buy gold. As we all know throughout history, governments love to have gold in their own vaults. They do not like to have their citizens own it in times of crisis. And they will go out of their way to make sure that they pry it out of your hands either justly, in a just manner or in an unjust manner. So I think that that's one of the things that's happening. The other part that I found really interesting at the end of the year, and this to me was the telltale sign of the bottom of the gold market. And by the way, I'm telling you, you've seen the bottom of the gold market. And that was Goldman Sachs. When they came out with their, this guy, Jeffrey Curry, who's their commodities analyst, came out at the end of the year and said, gold is a slam dunk sell in 2014. And he gave a bunch of reasons that the government was going to get its act together and they were going to resolve the budget deficit talks and all these things. But he basically said it's a slam dunk sell and it's going to 1,000. Which reminds me of when Goldman Sachs said a number of years, about 4 or 5 years ago, when oil peaked at 150, that it was going to 250. And it turned around and went straight back down to 80 from that moment on. I'm always suspect of Goldman Sachs that whenever they make these very bold and sweeping statements, they have a dog in the hunt. And I suspect they have a dog in the hunt on this one. And I will go as far as to say, as all my witnesses, that I will make a bet with Jeffrey Curry that if I'm right and he is wrong, he gets to stand in the middle of Robson Square in ladies' underwear and sing Patsy Cline's "I Was So Wrong." If someone can deliver him that message, I would much appreciate it.
Nice. Well, wow, okay, Frank. I don't know how to follow up on that. So we'll go with you.
I'll give you sort of a different view on it,
Yeah,
which
please.
I do agree with Frank, but I've written about this on this love trade and fear trade, and fear gets most of the media's attention. And Q1, 2, and 3, we saw lots of money going into the banking system, but we didn't see money velocity go up. Money velocity is what's highly correlated to bank lending and loans and the capacity to get loans. And this is a key factor for inflation. So you have excess capacity still, and the government can keep rates so low to try to fill that void, but there'll be a reckoning, and it'll be, gold will all of a sudden snap to it, and you're going to get CPI numbers. But this time last year, you had a negative interest rate on treasury bills, 1 year, 3 year, 5 year, 10-year government bonds. Today, you have a positive rate of return on 3 year, 5 year, and 10-year government bonds. So whenever you get a positive rate of return, it puts pressure on gold. And the government's going to do everything to try to keep the treasury bills, because I know the pain of having 1 basis point on a money fund and trying to support it at $1. I know what it's cost me millions of dollars of trying to keep a money fund. And it's interesting to watch how mortgages all of a sudden pop up, but it didn't happen here. So it's just delaying. All they're doing is deferring and delaying this inevitable inflation that's going to hit. The other part that's really important is the 60% of gold demand is the love trade. And this is highly correlated to the GDP per capita of Chindia. You go to a Bloomberg, it's got a function that shows you as GDP per capita has been rising, gold rises. And with that, you've seen in India, in fact, their GDP per capita has gone flat for a little over a year now. And I think that this year now we're going to see a rising GDP per capita, and you will see gold showing up in consumption. But what the government wants to do in India, it's manipulation of their current account. Because as gold comes into the country, it gives them a negative current account. Indonesia is trying to stop exports of commodities, et cetera, to play with this negative current account, which affects their currency. So if gold, in fact, was all underground, that the post office didn't sell gold in India, that banks didn't turn around to sell it and have to report it, no report doesn't affect the current account deficit. It looks pretty. So they basically try to push the gold trade underground. That's what I really think is taking place, because when I was there 6 weeks ago, gold was trading at inexpensive jewelers. Go in and you can buy a gram of gold, 10% mark of the price of gold is normally what it takes, is the price. But you are paying $1,600 an ounce. So there is this premium for that physical gold. And come back to the thesis is that what will take gold up, in our thoughts here, is that this rising PMI, Purchasing Manufacturers Index, is highly correlated as a lead before you start seeing all the metals. There's an 80% probability of energy and base metals rising. And we saw this global PMI turn positive in the summer, and all of a sudden you start seeing it showing up in many of the commodities. And this relates to job creation. And it's so important to recognize that Europe is a more significant trading partner with China than America is. I mean, everyone thinks it's America and China. No, it's Europe. So rising manufacturing in Europe is actually very bullish for India and China's rising GDP per capita, which then impacts this love trade consumption of gold. So I think I agree with Frank that gold is basically the worst over. I get asked to go on CNBC to get set up by Simon to attack me on gold. It's just bizarre to watch this behavior of this emotional intensity of media in New York hating gold. And it was really at the crescendo was in December.
Well, let's just stick with you on a theme you mentioned with respect to the PMI and the growth there. You know, yeah, you're absolutely right. We look over the last 6 or 7 months and we've seen what looks to be, increasing or sustained strength in PMI data globally. You've got the Eurozone coming out of a recession. What would make that strength sustainable? In other words, how will we know that this trend we've seen is for real?
I think this steep yield curve, I think this making cash so cheap for funding with the banks, and I think there's excessive regulations. In the U.S., I know for refinancing mortgages, my employees talk about it. There's still excessiveness, so it's going to be a slow process. You're not going to go back to 2005 and 6 where all commodities were in a raging bull market. You're going to get this selectivity that's taking place.
Any other comments on that? Sustainability and manufacturing data going forward? No?
My only comment is that, yes, it's good news. I just wonder what happens when you take away the punch bowl as they start this tapering. That's why I don't believe the tapering is going to continue the way that people are predicting it. Again, you need a growth in aggregate demand, and that hasn't really happened. You've had all this quasi-free money being doled out the last 5-6 years, and very easy fiscal policy or accommodative fiscal policy easy monetary policy or ultra easy monetary policy, and still the growth has been really anemic. And you haven't seen it in CapEx spending, you haven't seen it in job creation. So I don't know, unless you get a growth in aggregate demand, how, as you're taking away all of the stimulus, how that's going to continue without them having to go back and put back in that stimulus that they take away. And that's why I don't believe that you're going to get the tapering that you expect.
Sure. Okay, well, I have a couple more questions. I know we're going to run just a little bit late, but I think it's important that we address some of these issues. And Rick, we'll start with you on this one if we could. Something near and dear to all of our hearts, and the reason why we come to these shows is, of course, investing in the junior markets. How will we know when junior markets have hit bottom?
Got a question I might know something about. That's a pleasure. You never know when markets have hit bottom. The indicators, however, are around us. Ross Beatty on stage yesterday. I mean, Ross Beatty never does stuff like that for his health. He's planning a comeback. I hope he's in the audience today. Sitting to my left, one of the great recluses of all time, Frank Giustra. He's given these media appearances. He's sitting on stage. He knows when stuff is cheap. A market that's off by 75%, I mean, arithmetically, that means it's 75% less risky than it was before. This is my fourth cycle, and I'm not going to call a bottom. I'm always early, you know. I mean, sometimes I'm so early at a reasonable discounted net present value. I'm not early, I'm wrong, but in fact, often. But I'll tell you, I'm starting to see this market bifurcate. I'm starting to see the better deals catching bids last summer. Last year, if you came to this conference, the average exhibitor stock chart looked like a topographic map of Grouse Mountain. It was a very steep descending line from the upper left to the lower right. End of the year, you know, I said yesterday, it looked like the electrocardiogram of a corpse, just deadlined. The last 3 months, stuff's been catching bids. The flat line was where exhausted sellers squared off with exhausted buyers. Nobody did anything, so this market went sideways. We've had a little bit of buying, not much buying, but we haven't had any selling, so we've had these gap ups. And that's precisely what happened in the summer of 2000, which was I don't know if you guys remember that, but it was a truly spectacular time in the market for people who could pick stocks. The one thing that's missing, I hope the issuers in the room take note of this, is issuer capitulation. What we haven't seen in the market, because there's money available to move projects forward, we haven't seen the issuers come to market with financing terms that would bring the money in to drive the projects forward. Everybody's in survival mode. And if you're in survival mode in an industry where there's no cash flow, what you really are is in slow death. And we need to get through slow death like we did in 2000. You need to say, okay, I used to sell for $4, now I sell at 40 cents. I got to do a deal at 35 cents because I can't get it off at 40 cents. But when I do it, I get to move forward. Because if you're trying to hold something at 40, you're going to be holding it at 20, then you're going to be holding it at 10, and then you're going to be holding it at a donut. The only thing I think that's between us and a recovery are market clearing prices on financings to get projects and good teams going forward again.
I think you're just bitter because you're so greedy and cheap. And I've seen
This is great.
You know, here's the thing about the junior markets, and certainly as they appear today. No one's going to ring a bell for you, okay? It's better to be early than late. And I think you've seen the bottom in the junior market as you've seen the bottom in gold. And I think that the way you have to look at it is in markets, and this works both ways, is that you have to buy when it's overhated and you have to sell when it's overloved. And I've never in the 35 years that I've been doing this seen this sector so overhated. And so I think that you're going to probably do okay if you're selective. And I think you have to be always selective at first because you climb the wall of worry at the beginning of any market rebound. But I think this, you know, you can put yourself in one of three categories. You can either be the fox, who buys early and is smart and is there for the ride. You can be the chicken will sell on any immediate rebound as the market starts to pick up. or you can be the sheep and wait for the memo, which you won't get. And so I think that from my point of view, and I've been selective, and I've talked to Rick about this quite often, find those companies where you have great asset value or great growth potential, buy them. If they're grossly undervalued, they have nowhere to go but up, and all you need is patience. And I think it's about to happen.
The only place I'm have an exceptional call at tops and bottoms is South Beach. But as for looking at companies so cheap, well, one of the things you look at as you're talking to senior mining or resource CEOs, et cetera, is this trade-off people have to make at that level with their money. Do they go buy someone, or do they explore and develop? And right now, I share with you, the cheapest reserves are listed. They're not in the ground. They're listed. And one of the factors you look for are takeovers. When you start to see takeovers that are big premiums, not small premiums, and they have these gap ups, and we've seen this in particular in the energy space. Some of these takeovers of the past 18 months have been 80% to 120% premiums. And I think that that's a very key factor. And we're looking at Cisco recently was the takeover. It wasn't at a big premium, probably because the stock had already had one of the best performers for the past 3 months prior to that. But if you look at that from the bottom, it's very fair value, and it's a catalyst for more takeovers to take place. And I think we're going to get more takeovers in mining in Canada. I think it's a safe jurisdiction right now at this bottom of the trough as people are taking a look at maintaining the reserves and what they're going to look at. Any company that's junior, that's got all the permitting, it's got all these hurdles to be done, all the hairs basically been cleaned off, that they're going to become very attractive for funding and acquisitions.
All I'll say is we're climbing the wall of worry at the moment. So,
Sure.
along with Rick's, it seems, because we can't go anywhere in the world and not find one of his geologists under the rock already. So.
All right, I have one final question, and I'd like to hear from all of you on the panel. Can you tell us what is the biggest or the most valuable investing lesson that you've learned throughout your career?
Try to get in before Rick does.
And out before Frank.
I answered this question yesterday, and my most valuable investment lesson was living through the commodities bull market of the 1970s as a young man, competing with investment generalists when I was in resources and making a scat of money. And the consequence of that is I was, like any young male, a victim of hubris. I confused a bull market with brains. I thought I made all that money not because gold went from $35 to $850, but because I was a genius. And when the commodity bull market of the 70s ran out in the early 1980s, I remember very well February 3rd, my birthday, 1982, my investment goal for the year was to get back to broke. I figured if I could just get back to zero, I had the earnings potential to be okay. And that taught me about hubris, not that I haven't been subjected to it since occasionally. And it taught me about cyclicality in resource markets. It was an extraordinarily painful and extraordinarily valuable lesson.
I think the one for me was that, and the one that, strangely enough, most people have real trouble with, and I find this is a more of a function of retail investors than it is institutional investors, and that's the ability to sell too soon. You can make a lot of money by selling too soon, and a lot of people always hope to hold till the top. And one thing that kept me going all those years was that I learned how to sell too soon, and it worked out for me. You always have to leave some for the ducks. And the second lesson is to learn how to recognize when the ducks are quacking and feed them if they're quacking.
Wonderful. Any other comments?
Yeah, I work for one of the great and value investors in life, but it took me about 10 years of working with him to meet a gentleman called Rohit Siegel. And Rohit's also a fairly famous fund manager in Canada. Most of the people on the panel here would be familiar with him. And his great love is to average up, which really took me a long while to understand as a concept. And his thinking being that after he knows a company and he's known it well for a couple of years and he understands its business, why wouldn't you want to be there for the 50% that's before the blow-off? And if you want to invest your money and preserve your capital, it's sometimes a good thing to invest more money in things that you actually know and understand.
Ladies and gentlemen, how about a round of applause for the panel? Thank you.